Did you know that for every $10,000 in the average U.S. private financial portfolio, only $17 are invested in gold? That's just 0.17%, a stunningly low number for an asset that's supposed to be a cornerstone of diversification. A new report from Goldman Sachs highlights this massive disconnect. Over the last decade, the value of gold has soared, but portfolio allocation to it has barely budged. Their charts show a huge gap between current ETF holdings and where fair value levels tied to interest rates suggest they should be. Essentially, investors have missed out, with portfolio growth in other assets far outpacing any new money flowing into gold. This is where it gets explosive. The report reveals a powerful leverage effect. Because the pool of investable gold is relatively small, even tiny shifts in allocation have an outsized impact. Their analysis shows that for every 0.01%, that's 1 basis point, that investors shift into gold, the price could jump by about 1.4%. Think about that. A minuscule portfolio adjustment creates a significant market move. So, who is likely to make the first move? The report points to long-term institutional investors, pensions, endowments, who are also significantly underallocated. In an environment of persistent inflation and geopolitical uncertainty, these major players are being forced to look for true diversifiers. Gold fits that bill perfectly. A renewed focus on risk management could be the catalyst that starts to close this allocation gap. The key takeaway is simple. The current state of gold allocation is not a stable equilibrium. It's a coiled spring. The market is structurally underinvested. This isn't about timing the market, but about understanding a fundamental imbalance. As investors eventually move to correct this decade-long oversight, the potential for a significant repricing of gold is not just a possibility, it's a mathematical consequence. It's time to ask if your portfolio reflects this reality.